Right now, somewhere between your morning coffee and whatever you were doing 5 minutes ago, Bitcoin quietly touched a price it has not seen since June. It brushed up against $79,500. Then it pulled back a little, then it tried again. And here is the part that should stop you mid-scroll. Almost none of that move actually started in the crypto market. It started inside the bond market, inside a government office most people have never heard of, inside a decision about 30-year debt that, on paper, has nothing to do with digital currency at all. Before we go further, quick channel reminder. Because I say this every single time, and I mean it every single time. This is not financial advice. I am not your advisor. I do not know your situation, and nothing in the next 20 minutes should be treated as a recommendation to buy, sell, or do anything with your money. This is analysis. This is a way of connecting dots, and what you do with it is entirely up to you. Okay? Good. Let's get into it. Here's my question for you before we even begin, and I actually want you to answer it in the comments. Are you watching this on your phone during a break, or are you at your desk pretending to work while this plays in the background? I ask because I want to know who's actually here with me for the next 20 minutes, and because your answer tells me something about how you consume this channel. Type it below. Now, back to the number nobody's questioning enough. There's one figure sitting quietly inside the Treasury market that could decide whether this Bitcoin rally is just getting started, or whether it is about to become the most violent reversal we have seen all summer. I am not going to hand you that number yet. You have to sit with me through the mechanics first, because if I just throw it at you now, it will mean nothing. Stay with me. Let's talk about where Bitcoin actually sits today, on the 21st of August, 2026. Through the overnight session and into this morning, Bitcoin has been trading somewhere in the mid $76,000 to high $77,000 range, after briefly spiking towards $79,500 during the most intense part of this week's short squeeze. On prediction markets, the odds of Bitcoin reclaiming $80,000 have jumped as high as 85%. 85%. That is not a coin flip anymore. That is a market that has largely made up its mind, at least for the short term. To put this week in perspective, 6 weeks ago, Bitcoin was stuck grinding sideways between roughly $62,000 and $66,000, still down more than half from its all-time high near $126,000 set back in October of last year. Bears had been in control for months. Then, in the span of about 72 hours, everything flipped. So here's what I want you to notice. Bitcoin did not slowly climb here. It exploded here. And explosions like that always have a spark. The spark this time was not a crypto headline. It was not an ETF approval. It was not even a Bitcoin-specific story at all. It was a bond market announcement. Comment below if you had any idea the Treasury Department could move crypto prices this hard. I genuinely want to know, because I think most retail traders had absolutely no idea this was coming. On the 18th of August, the United States Treasury, under Secretary Scott Bessent, announced it would at least double the size of its long-dated bond buyback operations. Instead of buying back roughly $2 billion of older long-term government debt per operation, the Treasury said it would now buy back at least $4 billion per operation, covering securities across the 10-year to 30-year range. That expanded program is scheduled to run from the 9th of September through the 4th of November. Now, I know bond buyback sounds like the least exciting sentence in the English language, but here's what it actually means, in plain terms. The Treasury is stepping in to buy up older, less liquid government debt. Think of it as the government quietly changing the plumbing of the largest bond market on the planet. Why does that matter? Because right before this announcement, the 30-year Treasury yield had touched 5.337%, its highest level since 2007. That is a big number. That is the kind of yield that makes borrowing expensive for everyone, from mortgage holders to corporations to the government itself. When the Treasury steps in and increases demand for that debt, yields tend to fall. And when long-term yields fall, financial conditions loosen. Money that was sitting in safe, boring bonds starts looking for a better return somewhere else. Here's what they're not telling you in most of the headlines. This is not quantitative easing. The Treasury is not printing new money out of thin air the way the Fed did after the 2008 crisis. This is a management operation. But the market does not always care about that technical distinction. The market read this as a signal that liquidity was loosening, and risk assets, stocks, gold, and yes, Bitcoin, reacted immediately. Within hours of that announcement on the 19th of August, Bitcoin surged past $69,000, an 8% single-day move, its biggest jump since March. But, and this is important, the story does not stop at the Treasury did something nice and Bitcoin went up. There is a second engine underneath this rally, and it is the one that actually made the move violent instead of gradual. Here's where it gets really concerning if you were on the wrong side of this trade. For months, traders had built up an enormous pile of bearish bets against Bitcoin. The price had been stuck in that low $60,000 range for so long that shorting it felt like the obvious, safe play. Then the Treasury news hit, price snapped upward, and every single one of those bearish positions was suddenly underwater. When a trader's short and price rises against them, they eventually have to buy back the asset to close their position and stop the bleeding. That buying pushes price up further, which then forces the next wave of shorts to cover, which pushes price up even more. It is a chain reaction, and once it starts, it tends to feed on itself until the leverage is gone. On the 19th of August alone, roughly $1.4 billion in short positions were wiped out within a matter of hours. Some reports describe it as the biggest short liquidation event recorded since 2021. Across the following days, as the rally extended toward $80,000, total crypto liquidations across the week piled up into the multiple billions. So ask yourself this, and I actually want you to sit with the question instead of scrolling past it. When a price moves this fast, is it because real buyers genuinely believe in the asset, or because people who bet against it are being forced to buy it back whether they want to or not? That distinction matters more than almost anything else in this video. Real demand is durable. Forced demand from liquidations is temporary. And the honest answer is, it is probably both, at the same time, tangled together, which is exactly why the next part matters so much. Ask yourself something most people skip right past. Why would the Treasury need to step in and buy back its own debt in the first place? The honest answer is that the United States is carrying an enormous financing load right now, with national debt having pushed past $40 trillion. When that much debt needs to be issued and refinanced, and when long-term yields are sitting near their highest levels since 2007, the cost of simply servicing that debt becomes genuinely painful. Interest payments start competing with everything else the government needs to fund. So here's the paradox, and I want you to really sit with this one because it is the actual thesis of this entire video. The same intervention that is cheering up Bitcoin holders right now could also be read as evidence that the plumbing underneath the world's largest bond market is under real strain. It is not necessarily a sign of strength. It might be a sign of pressure being relieved because the pressure had become too much to ignore. That does not mean panic. It does not mean the sky is falling, but it does mean you should not treat this rally as purely good news without understanding what forced the move in the first place. Comment below with one word. Are you team, this is bullish liquidity, or team, this is a warning sign? I actually read these and I want to see where this audience lands. Now we bring in the other major player in this story, the Federal Reserve, currently chaired by Kevin Warsh, who was sworn in back in May after a genuinely contentious confirmation process. At the Fed's most recent policy meeting, the central bank held its benchmark rate steady in the range of 3.50 to 3.75% on a 9-3 vote. What is fascinating is who dissented and why. 3 regional Fed presidents, Cleveland's Beth Hammack, Minneapolis's Neil Kashkari, and Dallas's Lori Logan, pushed back not because they wanted lower rates, but because they were worried about the opposite. Their concern was that surging demand tied to the artificial intelligence build-out could keep inflation entrenched for longer than the market wants to believe. So here's the tension I need you to really absorb, because this is where most retail investors get completely blindsided. The market, right now, wants easier financial conditions. The Treasury's buyback move nudges things in that direction. Bitcoin, stocks, and gold all like that story. But the Fed's own internal debate shows real hawkish resistance. 3 sitting Fed officials are actively worried that conditions are already loose enough, or that they could become inflationary if they loosen further. Do you see the collision coming? The Treasury is quietly easing financial conditions through the back door of the bond market, while a meaningful bloc inside the Fed is worried about exactly that kind of looseness. That is not a small disagreement. That is 2 of the most powerful institutions in the country pulling in slightly different directions, and Bitcoin is sitting right in the middle of that tug of war. Let's walk through what happens if this tension actually breaks one way or the other, because you need to understand this before I show you what comes next. Scenario 1, the Treasury keeps supporting the long end of the bond market, yields stay contained or keep drifting lower, and the Fed, even with its hawkish dissenters, ultimately tolerates the looser backdrop because inflation data cooperates. In that world, risk appetite keeps building. Bitcoin's rally has room to extend, and the $80,000 level becomes a stepping stone rather than a ceiling. Scenario 2. Inflation data comes in hotter than expected in the weeks ahead. That hawkish minority inside the Fed gains more support, and the central bank signals it may need to stay restrictive for longer, even as the Treasury is trying to ease things on its end. In that world, the market that had started pricing in easier conditions suddenly has to reprice for higher for longer all over again. And when that repricing happens, it rarely happens gently. This is where Bitcoin's biggest threat over the next few weeks, probably, is not another crypto-specific scandal or hack or exchange collapse. It is the bond market disagreeing with itself. Stay with me, because the next part is genuinely the piece most Bitcoin content creators skip entirely. And it is arguably the most important chart in this whole story. If you are refreshing Bitcoin's price every 5 minutes right now, I would gently argue you are watching the wrong market. The chart that actually matters more, at least for the next several weeks, is the 30-year Treasury yield. Remember, it touched 5.337% right before the buyback announcement, its highest point since 2007, and that spike is exactly what triggered the Treasury's response in the first place. Bitcoin's next major move likely depends on whether that yield keeps drifting lower and stabilizing, or whether it violently snaps back higher. Bitcoin, historically, can survive volatility just fine. What Bitcoin actually struggles with is a sudden, sharp repricing of liquidity expectations. A calm grind lower in yields is Bitcoin's best friend right now. A sudden spike back toward those 5% plus levels would be the opposite. So here's a genuine curiosity question for you. And I want you to actually think about this rather than just nodding along. If you had to choose one number to watch every morning for the next month, Bitcoin's price or the 30-year Treasury yield, which one would actually tell you more about where Bitcoin is headed next? Drop your answer in the comments. I have my own opinion, but I want to hear yours first. Let's zoom back into Bitcoin itself, because that is obviously why most of you clicked. $80,000 is not just a round number for headlines. Analysts have flagged the $80,000 to $82,000 zone as a meaningful resistance region, a level where a lot of prior selling pressure has historically sat. Standard Chartered's Jeff Kendrick, one of the more closely watched digital asset strategists on Wall Street, has pointed to a possible move toward $100,000 by the end of this year, after the bank had earlier trimmed its longer-term forecast from $150,000 down to that figure. 3 realistic paths from here, and I want to walk through all 3 honestly instead of just cheerleading for the bullish one. Path 1 is the clean breakout. Bitcoin pushes through $80,000, holds above it for several sessions, ETF inflows keep arriving, remaining shorts get squeezed out, and momentum traders pile back in. That is the scenario most bulls are hoping for. Path 2 is the false breakout, sometimes called a bull trap. Bitcoin spikes above $80,000. Briefly, cannot hold the level. ETF flows cool off, leverage gets flushed back out, and price falls back below that resistance zone. This has happened to Bitcoin before, more than once, at other major psychological levels. Path 3 is what I would call the full macro breakout. Treasury yields stay contained, the dollar keeps weakening, ETF inflows keep accelerating, regulatory clarity around crypto continues improving in Washington, and Bitcoin breaks $80,000 with genuine institutional confirmation behind it rather than just short covering. This is the scenario the bulls actually want, because it is the one built on the sturdiest foundation. Which of those 3 feels most likely to you? Genuinely, pause for a second and pick one before I move on. I think your gut answer here says a lot about how you're currently positioned, whether you realize it or not. Here's what they're not telling you in most of the celebratory headlines this week. Bitcoin has already moved an enormous amount in an extremely short window, climbing from the low $60,000 range to briefly touching nearly $80,000 in a matter of days. That is not a gentle, healthy grind. That is a vertical move. Fast rallies like this tend to create their own risks. They pull in fear of missing out. They encourage fresh leverage from traders chasing the move rather than the ones who were already positioned. They create crowded, one-sided positioning all over again, just in the opposite direction from a week ago. And crowded positioning, whichever direction it leans, eventually creates the conditions for a sharp reversal when even a small piece of bad news arrives. Some analysts on trading desks have already floated that this could stall out somewhere in the $75,000 to $76,000 range without sustained fresh spot buying rather than short covering alone to carry it further. Others are pointing to real risk if the crypto legislation currently working through Congress, generally referred to as the Clarity Act, fails to make meaningful progress by roughly the middle of September. That is a real deadline sitting on the calendar, not a hypothetical one. So here's an honest question. No judgment either way. Are you someone who bought into this move already? Or are you someone waiting on the sidelines to see if it holds? Tell me in the comments, because I think both camps are watching this video right now for very different reasons. Here's a detail that tells you this is bigger than one asset. This week's move has spread well beyond Bitcoin. Ethereum and Solana and XRP have all posted strong double-digit percentage gains over the same stretch, in some cases outperforming Bitcoin itself. Crypto-adjacent equities have rallied too. And notably, gold has climbed alongside all of it, rising roughly 2 7/10% on the same day the Treasury made its announcement. When an entire asset class moves together like this, crypto across multiple coins, plus a completely unrelated asset like gold, that tells you this is not really a Bitcoin story in the narrow sense. This looks much more like a broader liquidity rotation, where money across many different corners of the market is reacting to the same underlying macro signal at once. Here's a curiosity loop for you to sit with for the next couple of minutes. If Bitcoin bulls should really be watching one other asset alongside BTC to confirm whether this rally has real legs, which asset do you think it is? I'll give you the answer in a moment, but take a guess first. I promise it's not what most people expect on a crypto channel. The answer is gold. And this fits perfectly into what this channel is actually built around, which is not just chasing crypto headlines, but understanding money itself. Bitcoin and gold have both been benefiting from the same underlying worries: concerns about the purchasing power of the dollar, concerns about the scale of government deficits and the growing national debt, and concerns about how much liquidity is quietly being pumped into the system through mechanisms like this buyback program. Some financial press has started calling this renewed pattern the debasement trade, where investors buy both gold and Bitcoin at the same time as a hedge against currency weakness, rather than picking one over the other. Here's the mindset shift I want to leave you with in this section. When gold and Bitcoin move together, the smarter question is not, are crypto traders feeling bullish today? The smarter question is, what is this telling us about the value of money itself? That is a completely different lens. And once you start viewing markets that way, you stop getting whipsawed by every single daily headline. Before we get to the ending, let me give you something practical you can actually use after this video ends. Point 1, keep watching ETF flows. If institutional inflows into Bitcoin and Ether funds keep arriving day after day, that is bullish confirmation that this move has real demand underneath it, not just leverage clearing out. Point 2, keep watching the 30-year Treasury yield. If it stays contained or keeps drifting lower, that is a supportive backdrop for risk assets broadly. If it suddenly spikes back toward those 5% plus levels we saw right before the buyback announcement, treat that as a genuine warning sign. Point 3, watch whether Bitcoin actually holds above the $80,000 to $82,000 zone, not just touches it. A brief wick above that level means very little. Multiple daily closes above it with volume behind it means something completely different. Quick check-in before we wrap up, because I like knowing who's still with me at this point in the video. How's the weather where you're watching this from right now? Genuinely curious? Drop your city or just describe it. I read every single comment on these videos, and it's honestly one of my favorite parts of making this content. So here is what Bitcoin's push toward $80,000 is actually telling us once you strip away the surface level headline. It is not simply Bitcoin is back. It is the market repricing liquidity in real time. Treasury policy is quietly reshaping bond market conditions. Institutional ETF investors are stepping back in with real conviction. Short sellers have been forced out of the market in one of the more dramatic squeezes in recent memory. The dollar is under pressure. Gold is rallying right alongside crypto, and Bitcoin is sitting directly at the intersection of every single one of those forces. Here's the line I want you to actually remember after you close this video. Bitcoin may not be leading this liquidity story. Bitcoin might just be the asset that reveals it most clearly, faster and louder than anything else in the market. I don't want to end this the lazy way with some generic, let me know what you think line. You deserve better than that, and honestly, so does this topic. Here is the actual question I want you carrying with you over the next few trading sessions. If Bitcoin breaks and holds above $80,000 while ETF inflows stay strong and Treasury yields remain contained, are we looking at the beginning of a much larger liquidity repricing across the entire financial system? Now flip it completely. If yields suddenly surge back toward those 5% plus levels, if the dollar strengthens again, and if ETF inflows dry up just as fast as they arrived, that $80,000 breakout could turn into one of the nastiest bull traps this market has seen all year. And that is exactly why the next major move in Bitcoin will probably not be decided on a crypto exchange chart at all. It will be decided somewhere far less exciting to look at, inside the roughly $30 trillion United States Treasury market, in a room full of bond traders who have never once opened a crypto wallet in their life. If this kind of breakdown, connecting bond markets, the Fed, the Treasury, and crypto in a way most channels never bother to explain, is genuinely useful to you, subscribe to the Wealth Continuum so you don't miss the next update the moment that bond market signal actually moves. Hit, like, if you made it all the way to the end, because that genuinely helps this channel more than you'd think. And if you know someone who keeps asking you, why is Bitcoin pumping? Without understanding any of the actual mechanics behind it, share this with them. It'll save you an entire conversation. I'll see you in the next one. Same channel, same honesty about what we actually know versus what we're guessing at. Take care of yourselves, and I'll talk to you soon.